All right, welcome to another episode of Asset Coach and Tax Strategist. I am Bob Wolf, and I am the CEO and founder of Terra Firma Business and Financial Consultants, and I'm an asset coach and tax strategist. So the goal of this channel really is to give you guys some content that helps understand the basis of what I call the economic termites. These are the things that eat away at your wealth. The main four are taxes, inflation, time, and laws and regulations. Law and regulations are our politicians. So in this process of understanding economic termites, they eat away at our wealth, meaning our assets. And we need to understand our assets. And so before we kind of dive into this episode more, I just want to let you know that we're not giving investment advice. This is for educational purposes only. This is just really for helping you get information so you can make informed decisions and give you information based on that informed decisions, that education. I don't know you specifically. I don't know your situation. So nothing we're giving here is going to be considered as investment advice. All right. So today's episode, what we want to talk about today is really focusing on something that we talk about in the investment world. Advisors talk about this as something called correlation. And so I'm going to go through the explanation of the definition of what correlation is, the types of correlation. We're going to talk about a little bit about what's non-correlation, so kind of the definition of non-correlation. And then we'll dive into what does this mean from assets perspective. My investments specifically. So what's this process look like? So this is going to get a little nerdy, but this is important because this is how financial advisors focus on managing the risk of your portfolio. So if you have, not to get ahead of myself, but if you have stocks, bonds, mutual funds, that kind of stuff, you need to understand the correlation between those because that's managing risk. And so advisors have to understand that aspect of it. And unfortunately, a lot of times that doesn't happen because within the institutions of giving financial advice, whether it's banks, broker-dealers, registered investment advisory firms, insurance companies, all that fun stuff, the reality is that they're regulatory or they're structured bodies that are there to control quote unquote risk. They're there to control quote unquote compliance, make sure everybody's doing the right thing. But the reality is because of that, also doesn't allow for true real advice outside of what those companies earn as fees. And I'm not trying to make the indication that they don't give you full advice because of not being able to charge fees. But the reality is that when it comes to investing, comes into assets, you and I as clients, you and I as investors go to professional financial advisors to seek professional advice, but yet they are unable to give you a full holistic approach of investment advice when it comes to certain types of assets and how those assets work. They're trained and taught certain areas and they have specific expertise, so to speak. But it's very ironic how this specific expertise a lot of times drives people to just mutual funds and ETFs. And so they're earning a fee for their advice, but yet at the same time, they're not necessarily giving the advice that creates this real diversification outside of what would be correlation. All right, so I'm getting ahead of myself. So let's dive back in. Let's reel this back and let's go back to what the definition of correlation is. All right. Correlation refers to a statistical relationship between two variables. If one variable changes and the other tends to change in a predictable way, either increasing or decreasing, they are said to be correlated. So basically, they're going the same pathway. Okay, the trend is they're going in the same pathway. They're separate things, two variables, but they're going down that same pathway. Okay, now there are types of correlation. So there's positive correlation, there's negative correlation, there's also zero correlation. So in my research, as we started diving into this more, when we look at positive correlation, it's when one variable increases and the other also increases, right? So if we're talking about stocks, you're talking about Apple and Google, for example. Again, not giving investment advice. If one goes up, typically the other will go up because they're both technology companies, right? And so therefore there's a strong possibility that they're both increasing. Therefore they're correlated. Now, negative correlations when one variable increases and then the other decreases. So for example, let's say Apple, and then let's say Kraft Heinz food. Let's say that goes down. Okay, so the reason they're non-correlated or negative correlation is because one's maybe technology. Well, not maybe, it is. Apple is technology, but Kraft Heinz is food. It's consumables. Okay, and so there could be something in the economics in the market that causes them to go different directions. Okay. Now, what's zero correlation? This is a discernible pattern or a relationship in how variables move together. Okay. So not that they're both increasing, not one's increasing, but there's this like, there's no understanding or this pattern that they're actually moving together, but they're not of the same. So it's a little more complicated. You would say, well, wouldn't they be positively correlated but it's if no discernible pattern, okay, or relationship within them and how they're going. So, for example, let's use Apple and Heinz food as Kraft Heinz Foods again. Okay, they're both going up. Well, they're both stocks. They're both public companies. It could be because the equities market is, and all stocks are going up. Okay, so that's a discernible pattern. I mean, they know why. Now, let's say you have Apple and a dry cleaner, local dry cleaner, and they're both going up. Both of their businesses are going up. Well, there's no pattern connecting them to. That's what zero correlation means. They're non-correlated. So non-correlation means that there's no relationship between these two variables. Okay, so the first part was there actually was relationship between the two variables. So zero correlation would be really difficult to understand it my stock example, because you'd have to have two stocks. That dry cleaner example meant that dry cleaner was a non-correlated asset. Right? So that wouldn't really be zero correlation, would it be? They'd be non-correlated. So in this no relationship between the two variables, this changes one variable. It doesn't predict the change in the other. Okay? So that's the benefit. Okay, now here's the understanding of how do these two things relate when it comes to investing and portfolio management. That's important. Portfolio management meaning your investments, right? So you go to a financial advisor and they say, "Oh, wow, let's take a look at your portfolio." What the first thing they're going to do is they need to understand your risk pattern, your risk tolerance. What is your comfort or what's your appetite to risk? Meaning, are you looking to take more risks so you can potentially get more reward, or less risk, less reward? What's that balance look like? So that they know how to allocate, they know how to diversify, they know how to rebalance and structure your portfolio in this correlation / non-correlation. But typically, a financial advisor will be all correlated. They'll deal with stocks, bonds, mutual funds. Where there will be a lack of correlation in that process is if they also offer insurance products, so annuities or cash value life insurance, permanent insurance, where it's a separate, but they still are licensed to offer that as part of that planning process. Okay. Where you don't see a lot of financial advisors is where they'll give you stocks, bonds, mutual funds, ETFs advice, maybe insurance advice. Okay. So your annuity contracts and your permanent cash value life contracts. But then they're also giving you investment advice on real estate. So multifamily or alternative assets is another area for those accredited investors. And a lot of you that watch this that are members of Terra Firma or thinking about being members of Terra Firma are all accredited investors. And so when you look at that, there is no correlation when you're looking at that, but a lot of financial advisors don't go down that pathway. Okay, so I digressed. progressed. I don't know. We'll see. You'll be the defining decision maker on that. So let's understand the difference between this correlation, non-correlation a little bit deeper. And this is extremely crucial when we're talking about this in context of, like I said, investment and portfolio management. So let's talk about correlation in investments. Okay, in investing, correlation measures how the two returns of two assets relate to each other. So positive means that, like I was saying, Apple and Nvidia, right? So you have two technology companies, both is very similar assets in the same technology category. They're correlated, and typically when one goes up, the other goes up. Typically, when one goes down, the other may go down. Okay, so there's a lot of similarities to the two, so to speak. Now, negative correlation means that they move in opposite directions. So this is where a financial advisor would need to look at the diversification of your portfolio from technology to consumables or defense or utilities, right? So we need to use these different categories within the investing to understand that. Okay. And so that way, when we look at zero or low correlation, that means the movements are largely unrelated. Okay. But it's really hard, like I was saying, that you would have to look at investing as a broader, holistic approach where you would have to include things that aren't necessarily public investments in the stock market equities to have this correlation relationship. So non-correlation would necessarily mean that, again, I have my stock portfolio, okay, and it could be diversified among different categories in that, but it's still a portfolio's equity portfolio. Non-correlated would be that real estate investment. So I own a fourplex. All right. What's going to happen in the stock market really is probably not going to happen in the fourplex. It would have to be a broader economic issue that would cause the two to go the same direction. Okay, so a great economy, interest rates go down, right? There's liquidity in the market. The unemployment is low, right? The economy is humming. Both are going up. They're different asset classes, but due to economic situations, they're now kind of going in the same direction in a correlation perspective because now they're part of your portfolio. And based on your portfolio design allows it to be correlated because the economics of the economy are making them correlated. But if you break it down to the very asset class of the equities versus the real estate, the fourplex, then they are not correlated. Does that make sense? So it's kind of like we're talking in circles here, but that's the reality of kind of building out a holistic plan. So when we're building out plans, working with accredited investors, they have alternative assets, but we make them non-correlated where we give them access to and help them have access to other alternative assets that are outside of the normal structure of broker dealers and registered investment advisory firms like REITs, real estate investment trusts. Well, I'm invested in real estate. Yeah, but that real estate is designed as a stock. And that's really helps financial advisors because now they can diversify a portfolio within real estate, but within REITs. But they're still public companies, so they're still an equity. So they're essentially still correlated, even though does that make sense? Now that real estate outside of that, and you're invested in a portfolio of apartment complexes with a investment portfolio manager that only deals with multifamily apartment complex investments, then that's non-correlated. Okay, totally separate. Now, when you're looking at overall portfolio management now of the two, we've got to look at the risk of the two and make the portfolio correlated. Here we go, circles again, in the sense that we're building a plan for you. Okay, so there still has to be a correlation, but there's a diversification in that. So why does this matter? So the goal of diversification is to reduce risk by combining assets that don't all move in the same direction at the same time. That's important. Now, you don't want to invest in assets that every time the stock market goes up, your real estate portfolio goes down. That doesn't make sense, right? You want everything, all asset classes to go up. So you have to be very mindful and do a lot of research and work with people who are very good at what they do in understanding which assets make the most sense for you as an investment person. Now, positive correlation in assets. Now, these move together again. So two tech companies rise and fall at the same time, like I was saying. Now, investing in highly correlated assets does not reduce risk. Okay. So then what I'm saying is that if I have an apartment complex or fourplex real estate outside of a portfolio, okay, am I saying I'm reducing risk? Technically, I am. Technically, I am. Now, what if all of my real estate that I have outside of my investment portfolio, my equities portfolio, is all in the same town? Now, that's correlated. It's not correlated with my investment portfolio, my stocks and equities, but my real estate's all correlated now. So now here's the thing. Well, what if I go into different towns within a same state? Well, they're all correlated due to the same state, but depending on the size of the state, they could be diversified. So like California or Texas, for example, there's such diverse regions. So for example, if I have real estate in Dallas, that's going to be a different market than Houston. Going to be a different market than Austin, San Antonio, or even a different market than Longview or Lubbock, Texas, or Abilene, right? The town and the makeup of the economics in those towns are different. So, yes, I'm still in the same state, but technically I could uncorrelate my entire portfolio because I have investments in these different marketplaces that are affected by economics differently because the economics of those areas are different. Yes, it can be very confusing. I agree, but very, very important in managing diversification. So when we look at negative correlation assets, like I was saying, these move in opposite directions. Okay, so they're non-correlated. So stocks and long-term treasury bonds. That's why in the investment world, they have splits of 60-40 investments and bonds, because technically they're not correlated, but they're still an investment. They're still based on the equities of the market, meaning that most people know that if I'm not going to be in a stock portfolio, I need to be in a bond portfolio. So therefore, your investment portfolio is correlated because there's still public investments. And so that creates, yes, diversification, but like Warren Buffett said, really diversification is for non-professional investors. You don't know. You shouldn't diversify. You shouldn't be diversifying. You're diversifying because you're not educated on the asset you're investing. So when you look at Warren Buffett, right, how many stocks did he hold? Like 5? Now, when he bought those stocks, he was all in, right? That's the point. Now, when he bought companies, he did diversify the companies in the sense he bought good companies that cash flowed. That's the basics of business. You need returns on your investment to be able to give those monies to your investors. But you also need those returns on investments so you can invest in other things and create more non-correlated or correlated investments, depending on what your goal is. Okay? Now, let's look at some asset pairs. This is important when we're talking about this whole correlation process, is understanding the asset pairs and what this looks like. So let me go back to my notes. So S&P 500, NASDAQ, they're highly positive in the correlation, right? They're both risky due to both being really without diversification. So now stocks and bonds, it's slightly uncorrelated because one is debt bonds and one is equities stocks, but they're both in the investment equities world, so to speak. Okay. Now, when you look at gold versus equities, now you're getting less correlated because that's why they always say use gold to hedge. Well, if everybody's using gold to hedge, then you're essentially correlating your entire investment portfolio. Why? Because everyone's going to that. So when A happens, everyone knows go to B. So you're creating this correlation by creating this herd mentality. All right. Now, when we look at real estate versus commodities, these are completely separate correlated. They are non-correlated. Commodities are different than real estate. Depending on the type of real estate also differentiates the commodity structure. Okay. But each of these asset pairs or each of these assets, you need to be looking at this correlation, non-correlation within each of these. So in real estate, if you're in commercial and residential, then you're creating a diversification, right? You're creating a non-correlated, but they're both correlated because it's still real estate. Does that make sense? So as we start drilling down to certain types of investments and assets, if they're similar, they're correlated. If they're not similar, they're not correlated unless they're still in the same asset pair class. So, for example, real estate again. Real estate is not equities. But if I have everything in apartment complexes, multifamily, I'm everything's correlated. But if I have something in commercial, so I have strip malls, for example, and multifamily, they're not correlated. But because they're in real estate, they are correlated, right? Chicken and egg, right? So this is important, especially when we start talking about this whole modern portfolio theory, MPT, optimizing risk reward trade-offs, and kind of looking at this. But the reality is, and kind of my focus here when we're talking about this is understanding that as an accredited investor, so now I'm talking to the people that we work with in physicians, medical professionals at Terra Firma that are members of Terra Firma. Every single one of them are accredited investors. So when we're looking at your overall assets in the diversification, the structuring of your assets, we have to look at uncorrelating your entire portfolio because that reduces the risk, but we don't want to reduce the risk at the risk of, the risk of lowering rate of return. So we want to look at, okay, if we're uncorrelating, that is a reduction of risk automatically. And so we can look at rates of return, especially in the alternative asset marketplace, because we have preferred returns we get to use. And depending on the type of structuring in the alternative asset class, as an accredited investor, you can actually have a kind of a different structure to where you could, if you wanted to, in your retirement funds, take more risk for more reward because you have a longer time horizon. Okay, so that's where time comes back into this overall portfolio. Art and science, baby, art and science. And so, but it takes the understanding of these very in the weeds conversation of building this out, but understanding that every time we build this out for you specifically, then your entire portfolio is correlated because it's yours, right? We could uncorrelate it if we separated you and your spouse and you guys had separate portfolios, then your household would be uncorrelated. Right? We can take this down a rabbit hole if you want. But you get the point, you get the idea of what we're talking about. And so when you're working with a financial advisor and all of the advice is in the equities, stocks, bonds, mutual funds, ETFs arrangement, and not outside of that, even when they talk about go into gold, a lot of times you're going into gold stocks. So you're still correlated. Unless you're buying gold completely separately. Now, but what is all the financial advisors saying? That go to gold to make your portfolio diversified and uncorrelated. Therefore, by everyone giving the same advice, everyone is correlated in that advice. I know. But these are important things to understand. These are your assets. These are your hard-earned dollars. Every time you walk away from your family and friends to go work and help other people and do whatever you do in your profession, you're saying that by me walking away, that time has to have value. And so when you come back in that you've earned those dollars, every single one of those dollars have value. You do not want to devalue those dollars by not understanding what's happening with your dollars. Okay. And so that's what the goal of Asset Coach and Tax Strategist channel is about, is trying to understand this, whether we're ragging on California or talking about China or talking about BRICS, right? Or we're talking about correlation versus non-correlation. Every topic we talk about is designed to help you understand, what do I do with my hard-earned dollar, which is a return of my time away from my loved ones. So every single dollar is of value and should be treated as such. Thanks so much for joining us. If you're not a subscriber, hit the subscribe button. We drop episodes every Thursday. Would love to have you. If you have comments, drop those into the comment section. Give us thumbs up if you like what we're talking about. If you have any questions or ideas of future content, drop that into the comment section as well. Until then, make it a great day.